Good morning, everyone. Thank you for joining me for the final episode of our New Term, New Skills series. Today, we're talking second charges. Throughout the season, we have looked at the basics of the different sectors of specialist finance, empowering you to identify the opportunity with your clients, discuss your options, and feel confident to move forward with different sectors. Second charge borrowing gives clients a way to access capital trapped in their properties for any multitude of reasons. But when should you look for one? How do you identify the opportunities? And how can you give your cases the very best chance of success? In today's session, our experts from Together Money and Tandem Bank will discuss the ins and outs of second charge borrowing, so you can decide if it is the right option for your client's needs, and then give your application the smoothest possible chance to completion. Now, this will highlight factors that can trip up borrowers, such as affordability, documentation, credit, things of that nature. And of course, we wouldn't be where we are today without your questions. At the bottom of the screen on Zoom, there is a Q&A button. Please utilize that throughout the session. We will endeavour to answer as many of your questions as we can, and we'll get your specific scenarios looked at and discussed on the panel today. And then to wrap up, we'll share a few success stories and keys to getting the best experience possible. Hopefully, by the end of today's session, you'll leave with a better understanding of second charge borrowing from multiple perspectives, how to avoid the pitfalls. So whether you're a seasoned broker or whether you're just second charge curious, hopefully you'll learn something from this session this morning. So without further ado, let's have a look at today's panel. So I'm delighted to be joined today by James Briggs, Head of Intermediary Sales, Personal Finance at Together, and Nigel Brookes, Head of Sales from the Tandem Bank Mortgage Division. Good morning, gents.
Morning.
Morning.
So to start us off with, I think if we just get a quick introduction from each of you, a little bit of your background within the industry, excuse me. James, do you want to start us off?
Certainly. Thanks, Chris, and congratulations on hosting another really well-attended event, it looks like. So, Head of Intermediary Sales at Together. Together's the fourth specialist lender that I've had the pleasure of working at in my 25 years working in the second charge industry. They just can't get rid of me. I also did 6 years working on the distribution side at a major UK packager. So I think that gives me a good perspective of both sides of the fence. Obviously, there's been a lot of regulatory changes in those 25 years. 2 or 3 recessions, numerous prime ministers, and a pandemic. But we sit here today in 2023 with seconds stronger than ever, I think. So, really excited about today and the future of seconds.
And Nigel?
Yeah, likewise, thanks for having us today. It's hopefully a good opportunity for everybody to have an Ask the Lender session. I think they're all really valuable. So I've been at Tandem Bank for just over 6 years now. So I've joined the bank prior to that on its journey from first start. We started off life as a small sort of niche lender and have grown through the last 6 years. People may have heard of us morphing into a lender called Oplo, and then latterly in the last sort of 18 months, our merger with Tandem Bank. But during my career, I started probably a little bit older than James. So since 1995, I've been in the consumer finance industry. And again, similar to James, I've worked for lenders and brokers. I was a broker, ran the operations director of a brokerage, D2C brokerage, pre-MCD days, and worked for GE Money prior to that as well. So kind of been through all those similar credit curves. Got several T-shirts. I've lost them, washed them, worn them. But been an exciting journey in the last 6 years with Tandem, and seeing its growth into positioning us as one of the largest lenders in the market at the moment. So, and again, I echo James's sentiment. Really, it's a really exciting time, I think, for the market. It's got its challenges, sure, with regulation and financial conditions, but I think the future's bright. Really, and we're looking forward to a strong. Let's get this year finished off, and a strong 2024 beckons, I think.
Thank you. And a little bit about myself. So I've been at Crystal for 16 years now, and 5 years prior to that in residential mortgages. At Crystal, various jobs from working on the BDM sales team right the way through to my current role as operations director. So I think doing a quick bit of maths here, there's about 75 years worth of experience on the panel as we're looking at the moment. So despite the youthful looks, we've seen I'm not going to say we've seen everything, because that's never the case. We've seen most things, and if you've got any questions, please fire them over, and we'll certainly do our best to answer them for you. So Nigel, sticking with you then, second charges is seen as a smaller part of the mortgage landscape, I suppose, by a lot of brokers. Just how big roughly do we think the second charge market is in the UK?
Yeah, it's a really good question. A good, I think a bit of misconception here. So let's go back to 2022 and its recovery after COVID. The market was around 1.6 billion in originations and sort of 35,000 units. So, it represents, it's a sizable market and much bigger than people think. There's 35,000 completions annually. That's, it's a lot of transactions. And then with the recent changes that we've seen in the market after the financial events of last autumn, they've affected all lenders. The main challenge being affordability, because rates have gone up and stress testing is more difficult and things like that. But year to date this year, the market's standing around 1.1 billion. So it's on trajectory to be around about 1.4, 1.5 billion. So some retraction, but I think it does highlight a couple of important things. One, the market is resilient. It's weathered the storms that we've all been through. The mortgage market's no stranger to those challenges. But consumer demand for second charge remains strong. It's very, very clear from those stats, I think.
There's some big numbers in there. James, anything to add to that?
No, well, Nigel's the man with the stats, so I'm grateful for him for bringing those to the event. But I would just kind of echo the resilience of the market. Really, yeah, we've seen some contraction versus last year, but that the same can be said for all sectors in mortgage lending, with where pricing is and rates are. No doubt we'll come on to talking about affordability, but affordability has a big impact on the size of the market at the moment. But I would just add there's two major lenders that are at various stages of applying for permissions and launching into this market as well. Major organisations, so they can see the potential growth of this market. And let's face it, historically, where high street rates have been uber low, it's kind of killed the argument a little bit for the second charge option. But now we're returning to a more kind of normal rate environment, even on the high street. There's not that many deals that start with a 4 at the moment. Thankfully, there are more coming back to the market. It just drives the need for this type of product even more. And that's a big focus about what we're talking to people about at the moment. It's using seconds to protect a client's high street status, or using a second to return them back to the high street. Anyone who's watching this thinking that seconds are an adverse credit product, please treat them with an open mind, because that is only a small part of the market.
There's a couple of good points raised there. And dependent on which metric you look at and where you get your news from, property transactions are anything up to 30% down this year compared to last. So for the secured loan market to be, looking at Nigel's figures there, on course for 1.4, 1.5 billion compared to 1.6 last year, there is a contraction, but it's nowhere near as big as we're looking at in other sectors. So it's certainly some strong opportunities there. And that could be down to multiple reasons. It could be down to the difficulty on the high street getting first charge, but it also could be down to people being more aware of second charge options, which we'll focus a little bit more on.
Yeah, I think it's also a question of being aware of customer circumstances. We're in the middle of an affordability crisis, and a lot of people are looking at many ways to try and save money in their monthly budgets. We've got wave after wave of people coming off low fixed rate deals that are now facing significant uplift in first mortgage payments as well. So looking at opportunity to save money I think is quite high in consumers' minds, and that's worthwhile bearing in mind.
Good point. So I suppose it leads us nicely into the common reasons for borrowing. What are the most common things that you're seeing now, and is there a change to what that's been in the past? James, you want to take that one first?
Yeah, sure. So I mean, I guess your traditional reasons for considering a second, if you're a broker talking to a client, is the capital raises midterm. So where there's no further advance available and the clients want to capital raise now, that might be through choice for a purpose like home improvements, holiday of a lifetime and wedding combined, or new motor car, or through necessity, which is that the standard debt consolidation. tax bills, those kind of reasons where the clients need to capital raise. And I definitely think there's been a further reduction in appetite on the high street for debt consolidation. So yeah, the purpose is a big one. You know, let's not beat about the bush. We did a survey a couple of months ago, and what are the challenges facing our brokers when writing business across the entire market? And 73% of respondents cited affordability. So it's harder. What you'll typically find with a second charge lending is the parameters and the calculations are more generous. If we talk about a couple of those now, that'd be quite useful. So it's very common in the second charge world for lenders to lend up to 6 times income, whereas on the high street you're typically limited to 4.5 times income, maybe 5 with some of the specialist lenders. As a non-bank lender, that together we don't have any LTI caps, so we base all of our lending on the client's actual affordability and actual expenditure. So we take a much more pragmatic approach, because we know there's a lot of clients out there that are failing some of the arbitrary models, but can truly afford, and it's responsible to lend to those clients. So affordability is a big one, and I'll probably let Nigel take a couple of the other ones, other reasons to use seconds. Now that I've nicked 2 of the most popular ones.
Yeah, and I'd echo the same sentiment. Really, it's affordability based. We can go to January. We operate. We have to have deep LTI limits in there, but we can go up to 8 LTI. We can go 6, 7, 8. But again, depending on client circumstances and ensuring that we do. Underpinning everything we talk about today is the fact that we must ensure that we lend responsibly. So that's always at the forefront of everything that we do as a second charge lender. But where the circumstances are right for the client, then and you can underwrite to a higher DTI or a higher LTI, then it's as long as it's in the client's best interest and a good customer outcome. And I think that also emphasises the fact that it's not the old system says no thing. We do humanly underwrite these cases as well. So there's a lot of manual intervention done to make sure that we achieve those goals. There's a lot more flexibility, I think, and you would probably find it refreshingly different from an underwriting perspective that we speak to our brokers, we speak to them about every single deal pretty much, to get that better understanding of what the client actually wants and needs. So I think that's also a good element to bring in with how we approach things like affordability. We do look at it. It's not heavily system driven, so to speak. So, but in terms of other main issues, again, I'd say we're more of a D2C specialist, so a lot of our business comes from brokers that deal direct consumer. We have seen an increase in the proportion of the business that is for debt consolidation, but also in parallel with that, an increase in home improvements. I think a lot of people are finding that projects they've undertaken have overrun in costs, so they're needing top-up funds and things like that. So they probably started a 100k project and the costs have exploded and need another 50k. So we're seeing a lot of growth in those kind of areas. So it's about understanding what your customers are actually up to, and also all the different reasons to raise capital. Recent credit problems. We are an all status lender, so we operate from the prime end of the market right through to the adverse end of the market. So people have had recent credit problems. Obviously, we can't lend to everybody, but as long as the trajectory or the life event could have been they lost a job or a relative or something like that. So we're quite open to understanding the client's needs and making sure that as long as the explanations make sense from a rationale perspective, and they're kind of through that bad credit period, and we can make sense of their future plans, then we're more than happy to lend people on that basis. But again, it's the sort of more specific reasons. It could just be the flexibility of the product the customer's looking for. Loan purpose. As James said, a lot of lenders are looking to tighten up in the general market, in the first charge market. So we can lend to higher LTVs. It could be product niche areas. For example, at Tandem, we can lend up to 95% loan to value. High LTVs are probably quite scarce these days in the first charge market. So again, we're quite comfortable at lending and with impaired credit up to high LTV levels. So there are opportunities out there, and also terms, obviously flexible terms. We also do third charge lending at Tandem Bank. So again, another niche opportunity that we can do. And all these things are business as usual for us. They're not special products that you have to get referred in advance. We're doing these transactions day in, day out. We probably complete about 1,000 deals a month. So, there are lots and lots of opportunities that may exist just purely from a criteria perspective, where an advisor may think that they can't find a solution for their customer, but one will exist if they look. And we probably talk in a bit more detail about some of those product niches towards the end, but I think there'll be a lot of opportunity just by learning the kind of products that are available from second charge. So there's an awful lot of possibility out there. And again, you go back to that 35,000 transactions a year. These customers generally access the market by going through Google, going through brokers advertising that Google space. So it's about, that's the size of the market and the size of the opportunity. So how many of those customers could be your customers? They could be that mortgage customer that you aren't speaking to or aren't communicating with, to make sure that they know that you can probably help them with their extra or additional borrowing needs. So I think that's really important as well, about keeping in touch with your customers.
Absolutely right. Yeah, those 35,000 clients have probably used a broker at some point in the past. They're probably sitting in brokers' client banks, not being talked to about these different types of options. So that keeping touching base with clients midterm is really important, because you don't want them going onto someone else's marketing list. Just one more thing on the flexibility point that Nigel mentioned. I think I'm right in saying you guys don't credit score at Tandem. We're the same together. So as the high street and traditional lenders kind of chase efficiency and the light touch approach, that personal common sense underwriting method that a lot of second charge lenders adopt can work really well for those cases that fall outside the stringent models for lending that are out there.
Yeah, I think just to add that, there is a broad range of purposes that some we can't do. We can't do. I know we can come up later on in loan purposes. We can't raise funds for deposits for buy-to-lets, for example. But there are a whole load of other things we can do. Obviously, debt consolidation being one of them. Paying tax bills, school fees. There are a myriad of any legal purpose basically you can think of. You'll probably find a solution for it with a second charge. Whereas you could be made to jump through hoops with first charge, remortgage, or further advance, where those sort of things again are BAU to us.
Two big things that jump out from there. I've been scribbling notes as you've been talking, so thank you for all of those. Certainly debt consolidation, base rates increased substantially over the last couple of years. So credit card costs and things like that have gone through the roof. So it might be an opportunity to look at some of the clients to reduce their monthly outgoings and maybe consolidate some of those if it's the right thing for them to do. But the other big one that's jumped out is that home improvements piece. One of the figures I quoted earlier, 30% down on house transactions. We're finding a lot more of our clients are looking to stay put and maybe improve the property rather than their initial plan might have been to go off and buy something else. So again, there's another opportunity there that if someone's coming to you for a purchase or to find a property to go and move to, if they can't find one, or what's their alternative? Are they going to add that additional room? Are they going to add the extension? My wife's badgering me at the moment to put an extension on our house instead of moving.
That's a really good point, Chris. I mean, we often get we'll come on sort of speed of process as well, but we can complete very, very quickly in terms of DIP to funds in customers' bank accounts. I mean, currently I was looking at our stats for last month. We were averaging this is across the whole portfolio. We're averaging 18 days last month. So we do typically get that home improvement deal where again they've run out of funds. They need another 50k, for example. Don't pay up, they're going to lose the builder. And we all know if anybody's been doing HR or anything like that, to get any kind of tradesman these days is, like, I'm living in Scotland, it's like hen's teeth, as they say. To get a good one as well, and then builders can just pick and choose and leave and stop jobs and things like that. So where there's an urgent need for funding as well, we can often very, very quickly and easily plug that gap and deliver those funds in a really, really timely manner.
So on the one final point for me on the debt consolidation topic, about, and go back to what I said at the beginning about getting clients prepared for the high street. If you're talking to a client and they've got 12, 18 months left on a 5-year fix and they've amassed 30, 40k on credit cards, let's say, when that mortgage term expires, they are going to have much more limited options if you're trying to move them with 40 grand's worth of credit card debt versus you wrapping that up into one affordable payment now and just trying to remortgage them with a second charge. Okay, it's looked at much more favourably, and it, from a calculations point of view, with some of the overhanging debt calculations on credit cards that the high street have, that can make the difference between the client having the market open to them or being forced into a product transfer with their existing lender. So it's satisfying a need, but it's giving them future options as well. But all of that comes from talking to your clients midterm, which is hopefully a message that's landed. And I think you should give your wife her extension, Kris. Stop being tight.
Yeah, it's either that or move, and we certainly don't want to do that at the moment.
Nah,
I think one of the themes that's going to come out of this webinar is it's about that relationship with the client, isn't it? It's not about doing that one transaction and then leaving them to it. There's much more opportunities throughout the journey. And, we talked about second charges. I don't want to use the phrase credit repair, but almost taking the client on that journey from being an adverse credit client to tidying up the situation to move to that high street situation. So I think we'll see a lot more of that as we go through the rest of this session today. So we've looked at the reasons why people do borrow. Have you got any examples of recent types of declines, or where the clients haven't been able to get what they're looking for? And we're seeing a few internally at the moment, certainly around that valuation piece, where we're seeing valuations come back a bit lower than people expect. So certainly if you're looking to push to a high LTV, we're seeing that probably impact a little bit more than we have done previously. Nigel, your turn to start us off on this one.
Yeah, good point as well. Again, as a kind of high LTV lender, if you like, that doesn't present too much of a challenge for us, because our clients can cascade up the LTV bandings that we do offer. For example, we can do 50,000 quid up to 95% LTV. We do like 100k up to 85% LTV. So we've got some really good headroom, if you like, in terms of product range. So and brokers kind of like us, if you like. So we've got that. I call it our stickability factor. If a Tandem deal tends to stay with a Tandem deal. We also, as part of our process, allow brokers to do the AVM up front as part of our originations process at DIB stage. So we actually pay for that as well. So and we also deliver a real rate decision, so the customer and the broker will know day one exactly what they're going to do. And we accept AVMs all the way up to 95% LTV as well. So we've got a hugely flexible product offering, and only when it falls out of bed with the AVM criteria, and we need a confidence level of 5 or 6. So 6 is a higher LTV, 5 just for everything sort of sub 90. But only then do we need to go to a RIC survey. We can drive-by is acceptable to us, as long as the valuation figures is right to get the LTV to fit. Then we're okay with that. We're pretty flexible. We are seeing a bit of a softening of RIC survey valuations coming back, and also in AVMs, because obviously it's an algorithmic model. So obviously house prices are softening as well, as you said. I don't think it's going to be as bad as that sort of 30% scenario everybody's talking about. I think we're great at talking the market down. It's probably going to be a 5 or 10% softening. So I don't think it's as bad as people are making out. But certainly for us, we tend to benefit in that regard, because we can keep the client in bed. So it's not a question of to resource or the deal falls apart or whatever. So our completion, back into completion ratios remain really high from a systemic perspective, because we've got plenty of runway, if you like. And so it's we don't see too much of that. Obviously, down barrels are bad news, but we can always somehow shape the deal. So the customer might get, if they wanted 50, we could probably get them 40. There's lots of ways to keep the deal alive with a second charge, where it doesn't die and fall apart. So it's a much better outcome, if you like, for the customer, where a second is considered live.
Thank you. James, any recent decline types that you've seen coming through it together?
Yeah, we're a bit of a self-employed specialist lender together on the residential side. So self-employed borrowers account for about 50 to 55% of our monthly completions, which we're really proud to support the self-employed in the UK, the backbone of the economy. Couple of reasons, and we handle a lot of high street and other specialist lender declines that come to us for self-employed related reasons. Some of the key areas where we can help those type of borrowers is We can use forecasted income for the current year if they're within 6 months of their year end. So if the tax year runs from April to April, from this point onwards, we can use our accountant's forecasted income up until April for the current year. So that really helps those clients who are nurturing young businesses. So we can do that from year 2 onwards. They need 1 full year under the belt, and then from year 2 onwards, we can use forecasts. That's also helped an awful lot coming out of the pandemic, because we've seen a lot of clients who've maybe left funds in the business and used grants or bounce back loans and supplemented their personal income and using those tools that were available, and they're not necessarily showing a level of income on their tax returns or accounts that would be conducive to lending. So that's where the flexibility of taking that pragmatic approach, getting a reference from the accountant who understands the business and who can articulate why the numbers are on the increase. We can also consider those borrowers who've only drawn minimal funds out of the business and retained profits. So as long as that's not a one-off, and that's like a trend that we can see over at least a couple of years, then we'll use retained profit as income, which is really useful. So self-employed aside, another trend that we've seen really since for the last 12 months, really since the cost of living crisis really took hold, is those clients that have taken second jobs, which again got a lot of respect for those clients because they're doing what they can to battle rising fuel, gas, water, electricity, shopping bills. Again, those type of clients are typically orphaned by traditional lenders. If they've only had a second job for 3 or 6 months, we can consider lending for as long as they've got the first 3 pay slips. That's cool. And finally, you've got those clients in the gig economy. Maybe the 0-hour contract clients who haven't been lucky enough to secure a permanent contract. As long as we can see some 6-month track record of earnings, and we can see some stability over that 6-month period, we'll lend to those borrowers as well. So yeah, all kind of really non-adverse related reasons, which is why I made the point at the beginning about it not just being an adverse product. You know, a lot of those self-employed clients that I talked about, they've got fantastic assets, amazing residential homes, but they just can't. The doors closed to them on the high street and with lots of other specialist lenders because of the makeup of their income. So we will judge each one of those cases, as you well know, Kris, because you're key supporters, on its own merits.
Flexibility is one of the underpinning things of second charges, isn't it? It doesn't just go through a computer model and come out with a number at the end. You've got the opportunity here to discuss what you're looking to do and to try and really structure that case for your clients, which is one of the big selling points for us of the sector. So moving on to, we'll come back to affordability in a second because there's a few questions that we've had in on that. So please keep your questions coming in. We'll address as many of them as we can throughout the session. James, sticking with you with this one to start with, MCD, consumer duty, broker opportunity. I know this is something I've heard you talk about many times in the past.
Yeah.
A lot of the time, not the brokers that we've got here, of course, but brokers will just default to that PT or to looking at a remortgage option. Why is that not the best approach?
Okay, I remember in 2016, me and a couple of other lenders, we went for dinner in Wimslow. Marie Grundy was one of them, and we were really excited about MCD and the opportunities that it was going to open up to the seconds market, because the regulator made it pretty clear, in my opinion, that if a client's looking to capital raise, the advisor should look at different options for them: unsecured, further advance, second charge with an external lender. The concept was great. In practice, a lot of advisors and mortgage networks as well remained quite closed to the option of seconds. I think because there was the ability for them to take it out of their scope of service, so kind of be blind to the second charge options, which is a real shame because you, I, and Nigel, we want the customer to receive a second only if it's the best option for them, you know. And if a further advance or remortgage is better for them, great, do that. But consider the option of a second. So we thought that's how it was going to play out with MCD, and it did to a limited effect. It did, but it didn't really realise the full potential. You know, I think that's part of the reason. That we're now in a consumer duty driven principle based environment, and you know, rather than being prescriptive about use this product, consider that product, do this, do that. You know, the language is quite different from the regulator now. It's all about protecting clients from harm, financial harm, predominantly, and offering fair value as well. And you know, if we're all honest, if that client's looking to capital raise and the option of a second isn't being discussed, so they might be paying an ERC if you're taking them away from you know, a midway existing fix, or you might be taking them away from a legacy product, you know, or a product that's no longer available. You know, that's a real kind of key point now. You know, anyone who took a mortgage out, yeah, a sensible LTV 3 or 4 years ago is probably sitting there with a rate that starts with a 2 or a 3. Those products just aren't available at the moment. So yeah, it's a good way of protecting them against harm and making sure they get fair value by having a look at this option. You know, you know, I've preached a lot about seconds over the years, but I just want customers to get the best deal. And yeah, as Nigel said, the big portion of the seconds market comes from those aggregators, you know, and those B2C brokers. So if, you know, if the customer doesn't think the option's available from their advisor that arrange their mortgage and protection, go away and find it somewhere else. You know, and you know, it's a lot cheaper to do business with an existing client than it is to go off and find a new client. And the final point I'll make on that is, you know, just by ensuring fair value, pick the right partner to work with, who can compare the market for you, like you guys do at Crystal. We've seen a bit of a trend at the moment with the mortgage networks and their ARs. They're moving away from letting the ARs deal with the 2 or 3 lenders that they can access directly, and they're steering them more towards packages, so customers get a wider choice of options to tick that harm and fair value box.
There's a couple of very good points in there. We're seeing a number of brokers who are telling the client to consider a second charge, but also telling them that they're not going to consider it. So we think, the broker might say, we think a remortgage is the best option for you, but go away and consider a second charge just to make sure you've covered that base. If the client finds something cheaper on Google or Compare the Market or wherever it is they're going to go through that. And then at that point, you potentially lost that customer for other transactions moving forward. So yeah, we're seeing, it probably backs up Nigel's point earlier that a lot of the deals are coming through direct channels, you know, aggregators, things like that, rather than the broker necessarily picking that up. Nigel, anything to add on that consumer duty piece?
Yeah, I think it's also what effect consumer duty will have on the market itself and the brokers that are operating in it. You know, obviously it's a serious piece of legislation. It's there to add on to what should already be happening, like in terms of treating customers fairly and so on and so on. But just creating that extra focus on ensuring that, one, from a lender perspective, our products meet the needs of target markets that we're operating in or choose to play in. And we constantly look at, as part of my responsibility, to look at, you know, make sure our product's design is good and suitable and trying to be innovative and so on and so on. But, you know, also for me, it is about that price and value. Let's deal with one of the elephants in the room. I think brokers historically have been either uncomfortable or nervous about the level of fees that get charged on second charges. There are a couple of reasons for that. One, it's a completely different process. There is a lot more work involved, although the cost of that process is coming down. And I think over the last few years, we definitely are seeing, and I can evidence that from my portfolio, that we are seeing fees on a downward trend because of the use of ABMs. You know, we're also a no consent lender, which is another opportunity for, you know, if the customer struggling to get consent from the first charge lender to any sort of second charge, we can facilitate that. But again, these things, we're stripping out cost and friction from the process. So we aim to be an easy lender to deal with from both a process point of view and a cost perspective. So that has to feed into the value chain. We will be, in regular dialogue with our broker network to sort of see what's happening with broker fees and keep driving those fees down, essentially, and making sure that they are representing fair value for the customer. And they've got to be relative to the amount of work that's being done for the customer for that loan. For example, if it's a 10k home improvement loan, that doesn't need a valve, just needs pay slips, and it's quite straightforward, that should have a proportionately lower fee on it versus one that's got 25 lines of debt consolidation, needs hours of work, and as James will know, it's self-employed, so it takes a phenomenal amount of work to package that deal and get it processed. So I think that will have a definite impact on the service and the fees that are out there. And again, like James said, brokers should go out and sort. There are some low-cost, low-fee brokers in the market now, and it's go and use them because they're good. They offer an excellent service and a really good price with a fee that's nice and openly displayed and very justifiable for the work that's being done. And also to make the service that the brokers offer now, they've got very, very big infrastructures with very complex systems. So the quality and level of advice, I think, generally across the market, obviously there's always going to be some outliers, but I think it's very, very good. The amount of work that goes into, say, let's look at the big one, which is debt consolidation. It is definitely is not for every customer, but the level of detail and attention that these brokers go through now, the process the customer's taken through, it's like line by line true cost analysis. That's the best practice. So also look at what your brokers are doing and what kind of service they offer, because that's what I would want a customer to go through. Like each credit card, right? You're paying 29.9 APR. We're going to put it, we're going to get a rate of 7% on this loan. If you carry on paying the minimum payment, it would take you 25 years to pay it off. You're going to pay it off in 10 years or 15 years to suit your budget. So it's a really well crafted solution that has a great customer outcome for the customer. So that's making sure that the customer understands what they're buying, and also I'm seeing much better evidence downstream of brokers supporting customers. So once they've done the debt con solution, it's like being in touch with them 3, 9, 15 months down the line. Make sure you cut your credit cards up, make sure you stop spending. We improved your cash flow by £900 a month. Don't you run off and start spending more credit again. It's making sure that they do what they say they're going to do, because debt consolidation should only be a one-time only solution. It's like it shouldn't be for everybody, definitely not. But there are some really, really value-add solutions out there. So I think consumer duty is a really good thing to make the market even better. So I'm a passionate believer in that.
I think the fair value piece that you both raised is a good point. Broker fees have historically been relatively high for second charges, and there've been some companies charging some huge fees to process second charges. And hopefully through consumer duty, it will bring things in line a lot more. We take the view that we charge flat fees. We don't take percentage fees on anything. It's a fee for a transaction, and that fee is transparent. It's upfront. It's split with the introducing brokers that are coming to us as well. So it's about making sure the customer gets the best outcome, not necessarily the one that's going to make the most money or the highest fee or anything like that.
Absolutely right.
Hopefully, consumer duty can be seen as a tool that people can use to offer that customer the best transaction, the best process, and making sure we are protecting all the customers from foreseeable harm moving forward.
Definitely.
There's a couple of big topics that I've touched on earlier that we'll come back to. We had a question coming live. What are the main tripping points of applying for second charge, and how long does the consent process usually take to obtain? Nigel, do you want to take this one up first, as you've already mentioned the consent piece?
Yeah, we by rote, we're a no consent lender, so you never need consent on a tandem deal under £100,000. So that's never an issue for us. But I can speak, obviously, I've been broker in the past, so consent depends on the lender. Some are notoriously horrendous at providing consent. One lender that I do, bank lender, will actually actively then go and they get a consent request in, will actually go and pitch the customer for the further advance monies themselves, which is diabolical behaviour, but because obviously everybody's got to pay for the consent. Consent can be between like 80 to 150 quid to get the broker has to pay for that. But generally, a good one will turn it around within a week, but some of the bad ones can be up to a month. But there are solutions out there where you don't need to get consent. We're one of those.
James, anything to add to that? The main tripping points of applying for a loan?
Yeah, just no difference really when applying for a first charge. So check the income that you're working with is accurate, what the client's told you. So when the pay slips get presented, that they're in line and the deal doesn't need to change. Make sure the client's realistic about the valuation for those minority of cases where full valuation is needed, because that's going to change things down the line. There really are no differences. It's the same documentation. Clients, you'll have a mortgage illustration presented for us, produced by the packager, so produced by you guys, Kris. And then that makes it really easy to compare the remortgage option with the second charge option, because you're looking at exactly the same document for two different products. So I love that. I would just a little bit of a cautionary word on the consent. That there have been historically instances where no consent cases have funded, and we will do those as well to limited loan to values. But the option of the customer taking a second is against the first charge lender's terms and conditions. So they've required immediate payment of that. So it's great to have the no consent option, but it's worth checking that that's not going to put the client in any hot water with their first charge lender.
Yeah, just to clarify for us on that one, we only register a unilateral notice with a restriction on. So because it isn't classed as a full second charge lien, it doesn't trigger that. For us, it doesn't trigger that issue with the first charge lender. It's only if a full true second lien charge is registered, and we register it, it's called a unilateral notice. So it doesn't fall foul of any restrictive covenants on the land registry. So it's perfectly safe.
I think the other thing with consent is make sure you've got a fax machine as well. The amount of lenders that still insist on faxing it through as opposed to emailing it out. It's the only reason we've got a fax machine left in the office upstairs.
I think the other thing, just things from our perspective on the whole app journey. So again, from us, it's a real rate day one decision. Our decision engine is quite sophisticated. When it tends to say yes, there's a very, very high percentage propensity that deal will go on to funds, as long as the rationale behind any adverse explanations are satisfactory. And also we do a soft search, so there's no hard search footprint. We only ever do a hard search at point of origination. So there's no harm in getting a quote from us, for example, because it has no customer detriment. You can get as many quotes as you want. But again, just to re-emphasize, we do offer a real rate day one decision with the ability to get the AVM done up front. So within a matter of minutes, if they go to a slick packager or broker, they will have a deal that is a real deal. And I think that's really important. Again, as James said, to make that all important comparison. It's like, okay, Mr. Customer, here's several options. We can either, you've got ERCs, or we'll do a PT and protect your existing legacy product, and then it makes a second charge a really good option. And here in the numbers, we can do it. We can get that information really, really quickly. So it's a really, the process is not as clunky as people may think it is. It's very quick and very slick these days. So, and again, there's no harm in getting a quotation. We probably at a front end, we probably see 12,000 customers a month coming through from an inquiry perspective. So the front end activity is enormous. So there are a lot of, if we're getting 12,000 inquiries at the front end, there's a lot of people looking at secured loans. So make sure, I guess the message is make sure you're one of them, I think, really. Because it's not as difficult as you think. And again, rate wise, if first to generate around 5s, 7, second to start around 7. So it's not a million miles away in terms of it's being an expensive product. It certainly isn't.
James, another question that's come in for you around buy-to-lets. How can second charges help in that buy-to-let space, especially with the difficulties people are seeing with stress testing?
Yeah, there's no doubt that buy-to-let's getting harder, isn't it? No doubt lots of the brokers listening have got a small, medium, even large portfolio in the background, and many of those will be on 5-year fixes, and there's going to be some decisions to make when they come to the end of those 5-year fix. Do you put the rent up? Can the customer stomach a rent rise? Is that going to result in a void? Do I sell? What's the capital gains implication of that? I'll start off by saying I'm a massive advocate of buy-to-let, and as a long-term investment, I love it. There's nothing like a tangible investment for me. Where can seconds help? In a few different ways. So we're one of the few lenders that will allow buy-to-let related borrowing on clients' main residences, but we can also do buy-to-let second charges on the investment properties themselves. Where we're picking up a bit of traction on the lending on the actual buy-to-let asset itself is the capital raising, but utilising top slicing. So those cases that are falling foul of the rental stress. Maybe they want to. It's a legacy buy-to-let. It's built up some equity. They don't want to move away from their existing first charge, or even they can't. Their only option is a product transfer. Let's face it, there's going to be a lot of buy-to-let mortgage prisoners out there. So stick with the existing lender, utilise top slicing and a second charge, release some of that debt equity, and use it for growth. They could use it for personal reasons if they wanted to. They could use personal debt console secured on a buy-to-let to keep the borrowing away from their main resi, which is what a lot of investors like to do. Or they could use it to further grow the portfolio. It's a buyer's market out there. There's fewer property transactions, and vendors, sadly, a lot of them are under pressure financially. So, there's always winners and losers in a challenging economic climate. And then you've got the lending on clients' main residences for buy-to-let related reasons, which is something we do a lot of, because a lot of those buy-to-let investors are self-employed because they've got no pension fund, and we do a lot of self-employed, as I described earlier. Some of the typical example is I've built up a chunk of equity in my main resi now, got a pension pot there. I want to invest in something tangible. I want to capital raise for buy-to-let deposit. Use that in tandem, excuse the pun, with a buy-to-let first charge, and acquire an investment property without dipping into any cash reserves the clients might have. So that's really popular, funding those. We've seen some even sexier examples recently where people have got an existing buy-to-let. They're looking at the yield, thinking that's not very exciting anymore. The capital raising on their main resi to convert it to a holiday home. Okay, so to extend it, put it out there on holiday let basis or a short-term let basis, or even we've seen a lot of Victorian buy-to-let properties that have been converted into HMOs or multi-units, and they've raised on the main resi for that purpose to fund the conversion, which gives them a massive yield in comparison to the single let asset. So all of those property related purposes that we talked about earlier on, the weird and wonderful purchases that Halifax won't be happy with if it's a further advance. Seconds are great. Seconds and certain second charge lenders are a great solution for those.
That just underpins the flexibility that you've both been talking about throughout the session today, that the lenders can find a way to structure these deals and can deliver the outcome that the clients are looking for. A lot of the time, it might not even be the outcome that you're thinking of to begin with, but we can deliver that outcome and ultimately what the client's looking to achieve. We're running a little bit light on time on this one, so certainly keep your questions coming in. Thank you for those. Start with you with the next one, Nigel. What do you see good brokers doing well when it comes to the second charge space?
I think it's presenting the case well. Give us relevant information. Don't give us absolutely everything, but it's help us make that responsible lending decision. Help us understand the client's income, circumstances. If they've had any problems in the past, why did they happen? We see it all. We've seen it all. We've heard it all before. We're quite used to and comfortable with dealing with people that've had credit problems in the past. It's not all about adverse, but complex incomes, variable incomes. Again, like James, we're happy to take second job incomes and 100% bonus over time, variable pay, and so forth, as long as it all makes sense. And it's getting that rationale and help us understand your customer and the customer circumstances. We are here to help them. I think that's probably the message I'd like to put out there, which is probably they might find a slight difference to the first charge market, where my understanding is they generally don't feel like the lenders want to help. Where I think you probably by engaging with second charge lenders, you'd find out that that's very much, I certainly know Together like that too. We're here to help people. You know, we're solution providers, and that's very much the DNA of a second charge lender. Is not the old computer says no. It's like, how can we find a solution for these customers? So well presented stuff, you know, good explanations, again, accurate information, in-date payslips, just the basic stuff really. It's not complicated. Make sure the application's fully filled in, there's no gaps in that. And, you know, would the lender ask any questions about anything I'm presenting to them? Is there anything here that doesn't make sense? Or, you know, if, like, say, for example, if you're self-employed limited company director, the pay that they're saying is on the payslip is in the bank account, for example. It might be a deal the other week where, you know, they roughly earn the same amount of money, but they were drawing it out of the limited company account and paying into the current account in different ways. But we found that out kind of after the event, and it took us a bit of time to get our heads around it. But if that had been presented day one, rather than being suspicious, it's like, okay, we'll get that. So give us and give our underwriters the information that we need to help make the right decision. Not, this doesn't make sense, so we're now going to start asking loads and loads of questions. That's we're only human beings at the end of the day, and our guys are no different to the mortgage advisors that are out there. They're just people that look at information and then we assess it next to our criteria and go, does this make sense? And if, you know, if the explanations are weak or poor, or, you know, sound like, you know, it's been sort of just plucked out of the sky, then, you know, we have to ask more questions, because we have to ensure that we lend responsibly, and we have to make sure that there's a good customer outcome at the end of it. So whatever help we can get in that regard, the better, really.
Thank you. James?
I'll just keep it really brief.
Doing well.
Yeah, so customer facing broker, explaining the concept of seconds to the client. You know, a lot of, you're not going to get any clients phoning you up saying, oh, I need a second charge loan, or I need a secured loan. It really does need the concept, explaining to them, hey, it's just like a further advance, but just with a third party lender. And also those brokers that can explain to the client that a higher cost product compared to a mortgage can be cheaper for the client overall. So I'm off, you know, this is a 7 or 8% product a second. I know your mortgage is on 3% at the moment, but this is the reason why I'm offering you this product now, because it's cheaper to do that, keep your mortgage in place, than move everything to a 5.5% product. I think that, you know, the real kind of successful brokers who are doing well out of this product line are confident having that type of conversation. And I'd probably just leave it at that, to be honest, Chris, in the interest of time. You know, all the packaging and presentation stuff as well that Nigel articulated as well. You know, I'll leave that to you guys at Crystal.
Yeah, well, that's the value that working with an experienced second charge broker or packager can really add to the situation. That not only will we know which lender on panel is the one to go with the particular scenario, but it's really working to structure that case, to package that case up, so that, you know, it does go in. And one of the phrases we use internally here is right first time. That when we do package a case and we do submit it to a lender, that's it. You know, we don't want that case bouncing back with additional questions. We want to get that deal right, get it in, get it paid out. Everyone gets the outcome that they're looking for. I think the other one, just to add to that, would be something we touched on earlier, is just looking for the opportunity as well, rather than just, no, I can't get you a further advance, sorry, or remortgage rate's too high, I can't get you the property you're looking to purchase. Well, what else can you do? How can you keep that client with you, and how can you make sure that you're covering all of that client's needs? I think the brokers we're seeing doing well in seconds are the ones that are actually looking at the client rather than looking at the transaction. Excellent. So just a couple of minutes left on the session there. So I think it's only fair I give you a chance to promote each of your lenders and to give your pitch to our attending brokers. James, do you want to start us off?
Yeah, thanks. I mean, hopefully that's been useful for people. I mean, we could sit here and talk about seconds all day, but they truly are a really valuable product to have in the briefcase. Make sure you're servicing them for your clients and not letting them go elsewhere. In terms of Together, I'd just say we're the largest non-bank lender in the entire UK. We've got 50 years of experience helping clients across all different lines of credit, but, you know, seconds is really in our DNA. And what we started with We've got a £6.5 billion lending book. So we are extremely experienced in helping those clients. I think we strike the blend beautifully of having the funding capability of a bank, but the common sense approach of a privately owned lender. And me and the other 600 and odd staff that work it together, we're totally dedicated to supporting brokers, helping clients meet those property ambitions. So thanks for the opportunity today, Kris, and thank you to all those brokers that have written business with together over the years, and we welcome you writing business with us in the future.
Thank you. Nigel?
Yeah, likewise, thanks for hosting today and meeting everybody, and likewise thanks to the brokers that do provide that support. It's much appreciated. Just highlights really those product opportunities. Really, 95% LTV, third charges as an option, consumer buy to let, adverse credits accepted. Our decision engine takes care of all that anyway, so that's generally if it says yes that the deal's going to pay out, really, that's what we're about, stickability. If we say yes, it's probably going to fund. So it's having that confidence in us as a lender. And we also got no construction restrictions, heavily AVM based, and a very fast turnaround time, really, that literally that 16 days DIP to funds in customers' bank accounts. So those options are available. And we also offer, as a greener, fairer bank that we are aspiring to be, EPC discounts as well. So, very competitive products and pricing out there. So please have a look and give us a try.
Thank you. If you take a look at the chat on the screen, you'll see a link that's just been posted in there. So there's a quick second charge 101 guide, which is just some basic information, which hopefully can underpin some of the things that we've talked about today. So you've got something to reference on the back of that. But look, that brings us to the end of today's session. Nigel, James, thank you so much for your time and for your expertise today. Some really interesting points that have come up. And attendees, I hope you all found that useful and that you feel more confident now to assist with your clients' second charge needs. If any of the topics today have given you the spark to go and help your customers, please contact our mortgage desk, 01827 337710, and we've got a team of people here ready to help. Otherwise, keep your eye out on your emails for details of our next session. All that's left to say is from me, thank you for joining. Stay busy, stay safe, and see you again soon.
Thank you.
Thanks.